comparing the accounts of Vanguard money market funds with Fidelity money market funds, both offer strong, reliable options for investors who want to park their cash in a relatively low-risk vehicle. But here's the thing, despite their similarities, there are some key differences that can make or break your returns. If you're wondering which one is better for you, we're going to dive deep into what sets these two financial powerhouses apart. Let's break it down, from expense ratios and minimum investment to fund yields and more. First up, expense ratios. Expense ratios are essentially the cost of running a fund, and they can quietly eat away at your returns over time. Vanguard's money market funds typically have expense ratios that range from 0.10% to 0.16%, depending on the specific fund. Not bad, right? But here's where Fidelity edges out the competition. Some Fidelity's money market funds come with even lower expense ratios, as low as 0.08% to 0.14%, and that small difference can add up, especially if you're investing large sums over time. Lower expense ratios mean you keep more of your returns, making Fidelity a slightly more cost-effective option in some cases. Now let's talk about minimum investment requirements. This is where Fidelity shines for small investors. Vanguard generally requires a $3,000 minimum initial investment for its money market funds, but Fidelity, it's far more flexible, often allowing you to get started with as little as $1,000 or in some cases even $0. That's right, if you're a newer or smaller investor, Fidelity's lower minimum investment threshold can make it much more accessible. What about yields? After all, the whole point of investing is to grow your money, right? Vanguard offers competitive yields with funds like the Vanguard Federal Money Market Fund, VMFXX, tracking closely to the Federal Reserve's short-term rates. But Fidelity's money market funds such as the Government Money Market Fund SPAXX and Fidelity Cash Reserves FDRXX often provide slightly higher yields. Why? Again, it comes down to those lower expense ratios. In certain market conditions, you might find that Fidelity edges out Vanguard in terms of yield, especially in short-term interest-sensitive funds. Both providers offer a variety of money market funds, but Fidelity has a slightly broader selection. Vanguard provides key options like the Vanguard Prime Money Market Fund, VMMXX, and the Vanguard Treasury Money Market Fund, VUSXX. But Fidelity? It has specialized funds such as the Fidelity Government Money Market Fund, SPAXX, Fidelity Money Market Fund, SPRXX, and Fidelity Treasury Only Money Market Fund, FZFXX. So, if you're looking for something more tailored to your specific needs, Fidelity may offer more options. If you're someone who wants to take advantage of tax-exempt money market funds, both Vanguard and Fidelity have options, but Fidelity offers a wider range of municipal money market funds. Vanguard has tax-exempt options like the Vanguard Tax-Exempt Money Market Fund, VMSXX. But Fidelity goes one step further with funds that cater specifically to different states, making it a better choice for tax-sensitive investors. Next, let's talk about technology and ease of use. Both Vanguard and Fidelity offer great online platforms and mobile apps, but Fidelity is often considered more user-friendly. Vanguard is known for its simplicity and long-term focus, but its platform can feel a bit outdated. On the other hand, Fidelity offers a more modern interface with advanced tools for tracking performance, making trades, and managing investments. If ease of use and a sleek interface matter to you, Fidelity could be the better option. So what's the bottom line? Both the Vanguard and the Fidelity money market funds are excellent choices, but they cater to slightly different types of investors. Vanguard appeals to those looking for trusted long-term options with a strong brand reputation. If you value simplicity and have no problem with the high minimum investment amounts, Vanguard might be the right choice. On the other hand, Fidelity may be more attractive to investors looking for lower expense ratios, lower minimum investments, and slightly higher yields. Fidelity also stands out if you need more fund variety, especially if you are looking for tax-exempt or state-specific options. One final thing to consider, Money market funds don't outperform stock market indexes like the S&P 500 during a bull market, but they are excellent for shielding your money during downturns. These funds offer stability and relatively high yields for the low level of risk they carry. Both Vanguard and Fidelity are offering yields above 5% as of September 2024, which is impressive in the current market environment. But here's an important reminder, money market funds aren't FDIC insured. This means they don't carry the same insurance as the traditional savings account at a bank. That said, they invest in very short-term, low-risk assets like US government securities. Fund managers aim to keep the net asset value at $1 per share, which is why these funds are considered so safe. But you should always be aware that there's a small amount of risk involved, as with any investment. Ultimately, whether you choose Vanguard or Fidelity depends on your personal goals. If you're seeking low fees and higher flexibility, Fidelity might be the better option. But if you value long-term reputation and are comfortable with a slightly higher initial investment, Vanguard could be your best bet. Both offer safe, liquid places to park your cash with yields that beat out traditional savings accounts by a mile. So now that you've got the breakdown of Vanguard versus Fidelity money market funds, the choice is in your hands. Assess your investment goals, think about what matters most to you, whether it's lower fees, flexibility, or a specific type of fund, and make your move. The markets are always evolving, and now might be the perfect time to take advantage of what these funds have to offer. That's all for today. Thanks for watching, and if you want more insights on the smart investing strategies, don't forget to like, subscribe,